please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good afternoon. You're with us here on a fresh new edition of Midcap Radar. I'm Prashant Nair. With me is my colleague Sumaira Abdi. The markets are absolutely quiet. Very little movement. I mean, we're down about 7 or 8 points on the Nifty. It means we've picked up, but I mean, not as if this is a 100-point recovery from the low. The range itself has been, what, 40, 50 points from the high to the low. I mean, I'm looking at sectoral indices. You could maybe look at real estate as an index, which is up about 2.5%. I mean, the IT index, yeah, to be fair, is up about 1.4%. But beyond that, beyond real estate and IT, there is very little movement. On the way down, the metal index is selling off a little bit. The Nifty metal, that's about 0.7% lower. And the pharma index is down 0.5%. But again, take a look at what's happening in the market. Still down 15 points. I mean, actually, we've slipped a little bit more. If we were down 7 when we started, we're down 15 points now. Ashwani is with us. Ashwani, thanks very much. I mean, last we spoke, you said maybe good time to sell Bank Nifty. Your thoughts now, you're reading.
See, basically the market is sideways and that range for the day was 10,580 to about 10,645. Now the market hit one end of the range, the lower end, and from there it has recovered. Now in the last couple of hours, it's possible we get back to that 620, 630 type of zone. And banks recover a bit, so that way some amount of short covering is likely, because once you don't break one end of the range, you generally go towards the other end of the range. And since morning, I think banks are the place where most amount of bashing has happened, and a few other smaller spaces like commercial vehicles, etc., Ashok Leyland, M&M, etc., are doing well, but overall the market still broadly remains range bound. As far as individual stocks are concerned, Escorts is a buy with a stop of 940, target of 975. Century Textile is a buy with a stop of 1200, target of 1310. And TCS is a buy with a stop of 3400, target of 3560.
Ashwani, any thoughts on DLF? I mean, it's showing some buoyancy. It's up 3%, 222. The recent low was about actually, it was under 200, 195 or so, I think.
It's not outperforming. I mean, I think if you see Godrej Properties or Soba, etc., they have outperformed DLF. And today, I don't think DLF has much to do in Mumbai. So I think for the day, you should be looking at Mumbai real estate stocks. But it's near its 200, 210 is the 200-day moving average. So that way, maybe risk reward is favorable. But even within real estate, I don't think it's outperforming.
Anything and more left in ICICI Pru to go?
I think it's bottomed out yesterday and possibly it can head up to 500.
All right, just quickly pull up the chart of Sterlite Technologies. That stock has shot up, actually reported very good numbers. And it's looking like a big improvement operationally as well. So the top line is up about 20-odd%. But look at the EBITDA. There's an expansion of about almost 45% over there. Margins have increased to 28% versus the 23% that they had done about a year ago. And all of this has cumulatively led to a near 80% rise in their bottom line. But we'll analyze those numbers a bit more later. Here's a big CNBC TV 18 exclusive. As Sanjeev Puri completes 1 year as the CEO of one of the biggest FMCG conglomerates, ITC, Shireen Bhan caught up with him to chat about the growth prospects. Puri says that the 1 lakh crore rupee revenue target may be delayed by a couple of years, but normal monsoons will augur well for rural demand. Let's hear him out.
GST was a very welcome step. It's indeed truly a transformative reform that is going to create a common Indian market, and it augurs well for the economy. So whilst there were some hiccups, and I would say that in fact hiccups are perhaps less than I thought that we would have.
Okay.
But the good thing is they are behind us, and we are much more stable today.
But with the GST in place now, I mean, tax, that probably isn't your number one risk or number one concern today, is it?
Well, in a stable environment, yes, illegal does not grow. And over time, it gives an opportunity for the legal industry to recover. It does. But that depends on really the tax regime. If it is stable, I think the legal industry should recover. The illegal industry will not get a fillip like it's been getting in the past.
What can we really expect now in terms of strategy and vision as far as the cigarette business is concerned? That's my last question on this before I move to the other areas.
Yeah, as far as cigarette business is concerned, it will be allowed to perform in the sector the way it needs to perform. It is not that because there is more capital employment in other segments that this segment is starved, right? This is a segment that has got surplus capacities today. I mean, the industry has got surplus capacity, right? And it's a fairly mature business, right? So therefore, it will get what it wants, but naturally, the order of investments will not be similar to new businesses, right? So that's why capital deployment is higher in other segments. It's 80% in the non-tobacco segment today, right? So as far as this business is concerned, as I said, we understand that there are going to be regulation, which is fine. We do not think it's in anybody's interest for us to cede grounds to illegal, to other forms, or for competition. So we will really defend our position.
Okay.
And we will advocate for that.
Give me a sense of what we can expect in terms of new categories that you intend to get into. When we last spoke, you had spoken about 4 categories. You've already launched your frozen shrimp business. You've already started your foray into the skincare business via an acquisition of Charmis. So, give me a sense of what next as far as new categories in the FMCG business.
Well, let me step back first and say that if you look at how the FMCG is performing, now we continue to grow much ahead of industry. And so is the case this year. And this is on the back of a comparatively much stronger performance in the previous year, which had its certain events which had led to a muted growth. We actually grew 13% FMCG in that year. And we are sustaining the momentum. And this year, as you mentioned, we've entered four new categories. We've put in about 30 plus new products into the market. In the year ahead, we will see an equal number of new categories that we will get into, a larger number of new product launches, and some of the categories that you will see us, or in fact, one of them that is getting rolled out as we speak is really frozen snacks.
Okay.
So it should be in the market very soon with the ITC Master Chefs under the ITC Master Chef brand. Right now we are doing the institutional piece, which will be followed by the real consumer side of it.
The target for the FMCG business is a fairly aspirational one at 1 lakh crores in revenues by 2030. Are you on track to be able to get to that number? I'm looking at your revenue picture for FY16, 9,751 crores, FY17, 10,522 crores, 9 months FY18, 8,277 crores. Are you on track to meet that number, or is it more aspirational in nature?
So you're right, it's an aspirational target, but nonetheless we are committed to that target, definitely, and that's how we are gearing up the enterprise, and that's the reason why we continue to widen and deepen our portfolio. We continue to strengthen our reach, our direct distribution. We are entering newer categories, and all of this is really directed towards achieving the goal that we have. Yeah, of course. The growth rates, I do understand, need to be much higher to be able to get to that figure by 2030. Yeah, so it may get delayed by 2-3 years, that's fine. But we are really gunning for that figure, and that's how we are organizing ourselves to get there. We are not giving up on that target.
You're not giving up on that target?
It's a question of the time, maybe a little bit here and there, but that ambition remains.
Okay, but what about the road to profitability as far as this business is concerned? Again, if one looks at the margin picture, FY16 0.9%, FY17 0.3%, 9 months FY18 0.9%. I mean, I understand that these are businesses that you want to invest in, and to some extent the investment will continue over the next few years. But what is the aspiration now when it comes to profitability?
Well, it's like this, that if I look at my business models and the cost structures around which these categories are being involved, I think they are fairly competitive. The ICMLs, for example, when we are bringing our manufacturing closer to the demand centers, and we also create the backward linkages in that region. So we get a very competitive value chain. Yes, in the short term, there are costs of having additional capacities, but ultimately, it will make us more efficient. And we are very confident that we are in the right direction as far as that is concerned. Besides this, you know, there are gestating costs of newer categories. You know, if you look at our portfolio, we have categories that I would say not even nascent, we are incubating. You know, we are really building on the brands, and therefore at the right time we will get to the market. So there are costs associated with that. But as our older categories, now we have, you know, for example, Ashirwad is a 4,000 crores plus brand, Sunfeast is a 3,000 crores. We have 3 brands that have crossed 1,000 crore mark, which is Bingo, Yippee and Classmates. So as our earlier brands have started to get scale, I think they are now in a position to more than support, at a P&L level, more than support the investments that we are going to make in the newer categories. So we will see a much better trajectory. But yes, it will be a while before we get to the benchmark level of profitability where we will be.
Before now, quiet on the market front, and the mid-cap index just barely in the green. So let's get in some important market opinion. Then earlier this morning, we caught up with Hugh Young, the MD of Aberdeen AMC Asia, who says that the heydays of Indian IT are over, but he does see good growth ahead for private banks.
I think it's, I mean, in a sense, its stunning heyday is over, so it's now a mature industry, which is obviously having to meet challenging changes in the businesses it serves, reflected obviously in the ratings that it now stands on. So the ratings have come down quite substantially from the high levels of yesteryear. If you look at, I mean, I guess the finance sector, certainly the private banks, have been in that stunning growth phase, and I think there's still quite a bit of growth to go for, there. But of course, as a country develops, as India has, by definition, the growth across all sectors matures to an extent, and we have holdings in the likes of GRU, and as you know, as a corporate, we've been joint shareholders of HDFC Life and HDFC Asset Management, which have been phenomenal success stories.
Okay, Hugh Young there with Aberdeen. GIC Housing fourth quarter numbers flashing at the bottom of the screen. Profits are up 29% at 60 crores compared to 47 crores, which they reported same quarter last year. 30% is very good growth. Revenues are up about 12%, 297 crores compared to 266 crores. So profits rising at a faster clip as compared to a top line. And we'll get you more from the release in just a bit in terms of loan growth and the level of, the NIMs, etc. In a bit. 4.33% higher on GIC Housing. Provisioning is steady. I mean, 23 compared to 23 crores same quarter. I mean, the last quarter, which is Q1Q. Okay, we'll, as I said, get more in a bit. But a whole host of other companies reported earnings through the course of the through the course of the morning, actually. We spoke with managements of Raymond, we spoke with Persistent Systems, as well as Tejas Networks. Let's listen into some of the most important bits of what they had to say as far as their respective companies are concerned, growth and outlook for their companies. Listen in.
Happy to report that the board has approved plans to monetize 20 acres of land for development for residential purposes. There is no cost that we have to incur towards the land acquisition, except for the approvals that we have to secure. There is a cost towards that, and we've spent already 100 crores in the fiscal year 17-18. We have earmarked another 300 crores for next year, and this is largely going to be towards construction finance, for land, for approvals and construction finance. And as the project, since the project execution is over 5 years, we do not see any major need for funding beyond this 18-19. We are looking at really a capex of 250 crores across all our group companies at a Raymond consolidated level, and which would include about 40 crores of capex for our apparel division.
The improvement in This is not going to be because of utilization improvement. It is going to be because of improvement in what we are able to charge our customers. Over the year, I think about 3 to 4% increments in rates have happened across the board. But again, they are not all like-to-like comparison because the mix of business has been changing as you go along. And the newer digital business that we have comes in at a better rate structure than the previous old business that we have.
We have said that a 20% CAGR on a medium-term basis, which is a 3-year basis, is what we had seen happening for us. And we believe that we will continue to do that. So we did have a shortfall in last year. The current financial year, we should be able to make up for the shortfall of last year. There are a lot of orders which we are either L1 or where we are very close to bagging from the customer, which should all come back and add to the growth momentum that we are seeing.
The market is down about 36 odd points, so that's not the story today. I mean, the story actually is the rupee, which is at the bottom of your screen, and that is set for the biggest intraday fall in the last 2 months. So, I mean, currencies across, emerging markets, developed market currencies, everything has been under pressure as against the USD. And we got some local factors playing out here as well. Lata is joining in to give us more perspective. Lata, what's happening?
Actually, more of the same. It's more of equity market selling. Year to date, even bonds have sold off. It's not like today there was selling, and even yesterday the selling and buying in the bond market matched, and there was a minor equity market selling. But things are just gathering pace. I'm a little surprised that it's happened today more because crude has actually moved away from $75 and is now even a little south of $74. It is 73 and change. Nevertheless, looks like it's, people are clearly taking a short view on the rupee. Expectation is that inflation is going to rise, and therefore, there will be more people who may want to pull out of India, both on the debt and the equity side. Already, when you see the US 10-year giving you 3%, a lot of pension money will want to go to that risk-free return and start buying. Maybe they will have better opportunities to buy, but it's quite possible that some of the money moves. For a whole host of reasons, people are definitely taking a view that rupee is headed towards 67, and therefore you're starting to see exporters not wanting to sell now. I will sell north of 67, and importers in a desire to buy forward rupee. So this is a combination of all that. The final reason why it happens in April is because a lot of dollars that wants to come back home, either exporter dollars, do come by March 31st. So April is traditionally a weak month for the rupee. Because you do expend a lot and flows don't come in. So this is a combination of all these factors. All emerging market currencies have shown a weakness in response to bonds touching 3% in the US. It's just that since we are a current account deficit country, it is showing up more for us.
I think the bond market is also, the 10-year is also up, what? Yields are up
7.75 when I last saw.
10 basis points or so.
7.6, I think about 10 basis points from last night,
yesterday's close, I think.
Yeah, so, actually, yesterday was an amazing recovery in the bond market. Then again, the sell-off has come in today, expectedly. After the bond yields. We've got, I think, Manish Vadavan of HSBC joining us. Manish, this 66.80 is looking eerily close to 67. Where is the dollar headed, you think?
Lata, I think overall impact of dollar rates, seeing sell-off in the bond markets also, as we've seen FPIs have been selling, and looking at the oil prices. It's a combination of everything, and we feel that at this point of time, the seasonality impact also comes in when there's a lot of demand of dollars in the summer season, and the flows are a bit slow. So it's a combination of all these factors which are impacting the rupee value today.
But we have underperformed the emerging markets, right?
You are absolutely right. I think the rupee reaction is far more than our counterparts in Asia Pacific also. So it's definitely underperforming at this point of time versus others.
Okay. Is there any one-off reason? Some big, sometimes people talk about a big defense payment going out and things like that. Is this a one-off, or do you think we are going to? This is just foreigners selling, and therefore we are going to continue to see more of this.
Lada, I don't think so there's any specific payment which has gone through which is creating this. It's a seasonality impact which typically happens also. There is a summer demand which just, goes up at this point of time, and the flows are lesser in April and May. Because the bunched up flows which come in March, they don't come up in April, May. Absolutely. It's the normal exporter selling which happens, which creates this kind of a gap. So it's a combination of both the things, demand-supply mismatch at this point of time, and also the issues which are plaguing don't come up in April, May. Absolutely. It's the normal exporter selling which happens, which creates this kind of a gap. So it's a combination of both the things, demand-supply mismatch at this point of time, and also the issues which are plaguing our markets today, whether it's FPI selling or whether it's high oil prices, etc.
Okay. What about public sector banks? You don't see them coming in and supporting the rupee, supplying dollars?
Lada, I think the stated stance at RBI is that they try to contain volatility. So you see at every point of time some kind of a supply from the public sector banks, what you're talking about. But that doesn't mean that they would be looking at a certain level and they'll be trying to defend that level. We have not seen anything of that sort. Yes, some kind of intervention always happen at all points of time.
Okay. Well, finally, what about the bond itself? Yesterday we saw a recovery to 7.6667 levels. Today we have again crossed the 7.75 mark. Now, just 4 basis points away from 7.8. This is a response to that 3% on the US. What is the next for the bond markets?
I think we were near 3% yesterday also. Yes. But I think markets have different kind of moods in different days, but might be there was some flow also yesterday, and which was holding up the bonds. And when the market normalizes, and basically one more issue, which is although not so important but technically important, the auction got preponed by a day. So normally they do an auction on Thursday, Friday. It's tomorrow the auction now. So it's a mild pre-positioning also before the auction, but not to deny the other impacts of oil and the dollar yields too.
So 7.8 is here, or do you think at that level it becomes attractive to buy bonds?
Lada, I think the way markets have been going on in the month of April, these are just numbers now. It's more to do when there is a stability come. Yields can be justifiable at 7.5 also with a repo rate of 6, or even with some people who are talking about rate hikes. So I think it's just a number. It's a matter of when stability returns to our markets. It's at the moment low volumes and high vols. So it can move around anywhere at this point of time.
All right. Thank you very much, Manish Vadavan, for joining us. Back to you, Vishal.
Thank you very much for taking us through that. I mean, that's essentially going to be a big focus area for us over the next couple of hours as well. I mean, is the stock market paying attention? I think it is. So the Nifty, when we started talking, was down, 35 points? We're down 50. The Nifty is down 50 points, 10,564. So one has to wonder which is the head, which is the tail. But looked like, stocks were leading. And so it's a bunch of things. The Midcap index is also down 70 points. Bank Nifty is corrected 200 points. So there is a sharp move accelerating on the way down on stocks as well. We're going to take a very quick break here. And Sumaira and me are out of here. Your stocks is going to be with you in just a bit.